Okay, so we're going to have a look at the 2014 marginal costing question today. 2014 costing question is split very clearly into a part A and the part B. Now, the part A is about one company, and it's, let's say, a typical marginal costing question. There's going to be some assumed knowledge in that because I've already taught that in the 2011 video. So I'm going to go through that reasonably quickly because of some of the material has already been covered. And then part B is a completely separate question. It is to do with a company called Barry Limited, and this is something which was asked in the year 2006. It was asked again in the year 2014, and it's been seen in several mock exams as well. So we'll do that afterwards. But let's first off look back and look at the question 2014, question 8A. It says Murphy Limited produces a single product. The company shows a profit and loss account for the year ending 2013, during which 16,000 units were produced and sold. So it tells you about the sales, the materials, the direct labor, the factory overheads, the administration overheads. And this sentence underneath here is a key sentence. This tells you how to break down the setup of the question, which we've done before, so in the 2011 question. So it says the materials, the direct labor, and 1/3 of the factory overheads are variable costs. And then 65,000 of the administration expenses are fixed. You can see there that there is no percentage link to do with selling expenses or commission or anything like that, which means we don't need that base variable cost procedure that we did in the 2011 question, but nevertheless, we will have to do some tricky enough little maneuvers as we get into it. Let's look at part A. First off, you have got the setup now. So, as the question said, it tells you the materials, the direct labor, and 1/3 of the factory overheads are variable costs. So therefore, those three can go in as variable costs. Now, 1/3 of 60,000 is obviously 20,000. That means the other 2/3 is a fixed cost. And then it says about administration expenses, it says 65,000 of the administration expenses are fixed, which of course means that the remaining 40,000 are variable. So when you put all of that information in there, you're going to get a variable cost of 290,000 and a fixed cost of 105,000. We can go down to our marginal costing statement and we can input that sales, less variable cost, contribution, less fixed cost gives you your profit. So we have, for the total 16,000 units, we have our sales of 480, take away the variable cost of 290, and that gives you contribution of 190,000. Take away the fixed cost of 105 gives you a profit of 85,000. You check to make sure that's corresponding with the profit in the question. Indeed it is. It was 85,000 in here. And so therefore you're confident that you haven't lost any money as you've done that procedure. And then we're going to do this per unit. So if we divide by 16,000, we find that each individual unit we sell for €30. Now, if you divide 290 by 16,000, it actually gives you 18.125, and the Department of Education marking scheme here required the 3 decimal points, which it didn't previously, but it's a warning that if it does give you 3 decimal points on the calculator, you might as well give them. You cannot be penalized for being too accurate. So therefore, this 18.12 cent, you take away from 30, and that gives you a contribution per unit of 11,875, €11.87.5. Now we can delve in now to the actual question. Well, the first part of the question is our standard, and I've taught this before, the break-even point. So we know that the break-even point is just fixed cost divided by contribution per unit, which in this case is 105 divided by 11.875. And when you use your 3 decimal places there, you're going to get 8843. Just checking on the calculator to see if that comes out even. Now it's actually 8842.1. So you always round up to the next full unit in marginal costing. Even though it's only 0.1 on your calculator, you're going to round up, because let's say this is a hoodie, for example, or a top. Well, they're not going to make 0.1 of the top and just leave it there. They are going to finish out that unit of production. So you always round up to the next full unit. And then that will give you a margin of safety, sales take away break even point. That will give you a margin of safety of 16,000 minus 8,843 gives you 7,157 units as your margin of safety. Question B says, roughly sketch a graph showing your break-even point. Well, there's 8 marks for this graph, and I'm just going to show you some of the key features that need to be in it. So this is lifted from the marking scheme. So first off, fixed costs is a horizontal line because they stay at 105,000 regardless of your output. I suppose I should mention here, this is euro, costs or revenue, and this is units. So that's 105,000 euro horizontal, regardless of whether you make one hoodie or you make 10,000 hoodies. Your total costs, which is your fixed plus your variable, will not start at 0 because it has to start at 105, the fixed. So it climbs from here and it goes out here, and you label that TC or total cost. Whereas your total revenue does start from 0 and it climbs at a slightly faster rate and it goes up to there. And where the costs and the revenue are identical, that is your break-even point. And we know from this question that that is 8,843 units, or 265,290 in euro if you multiplied it by the selling price per unit. That selling price per unit was 30, wasn't it? Yeah. So if you multiplied 8,843 by 30, you would get this number here either. So therefore, that's your break-even point. Now, one interesting piece of information where I'm going to put the cursor now, before the break-even point, you can see that your revenue is smaller than your costs. Hence, all of this information and all of this is a loss. And your loss is decreasing, decreasing, decreasing until eventually you break even. And then after your break-even point, your revenue exceeds your total cost. And all of this is a profit. And the profit grows the more you produce. And that's called economies of scale. The later units you produce are more profitable, and because you have covered your original fixed cost through your contribution. So that's a break-even chart, and you need to have all of those things labeled and inputted in to get your full 8 marks. Now let's look at question 3. What did question 3 say? I might just flick to the question to see it. It says, calculate the profit the company would make in the year 2014 if it reduced its selling price by 5%. You need to take that off to 30. Increase fixed cost by 5,000. And that's going to be a fixed cost. Sorry, increase advertising by 5,000, but that is a fixed cost because it is a lump sum, not a per unit. And increase the number of units sold to 19,000, everything else remaining the same. So quite simply, we just put in those changes. You have got 19,000 units by 28.50. Now, what is 28.50? That is 30 euro less your 5%. And that gives you 541,500. Then you have the variable cost remains the same because there is no percentage link here between selling price and variable cost. So it's still 19,000 by 18, 12.5. And that gives you 344,375. And the fixed costs, well, because of that extra advertising, that's going to go from 105 up to 110. And you subtract those numbers to get your profit, and your profit in this case is 87,125, which is slightly better than the profit you were already making. So perhaps that's an option worth considering. Part 4 of the question says the number of units that must be sold at 26 euro per unit to provide a profit of 20% of the same revenue from these units. Well, this is our basic algebra. This was part 5, I think, in the 2011 question we did. It's an algebra question where we're going to let x equal the number of units. And therefore, we know that sales, take away variable cost, take away fixed cost is going to give you the profit. So that's 26x minus variable cost is 18.125x, whatever the units is, minus the fixed cost, which is the original 105. And that's equal to, now how did I get this 5.2? That is 20% of this number. 20% of the 26. And when you work that out for x, and being mindful of the 3 decimal places here, when you work that out for x, you're going to get 39,253 units rounded off. That's how we do part 4. And then part 5, I'm just going to go back to the question and read part 5 here. Part 5 says calculate the profit the company would want to make in 2014 if there is a sales commission of 5% of sales given to sales personnel. So here we have got a sales commission personnel and €1 spent on extra packaging. Now both of those are going to be variable costs because they will increase according to how many things you sell. Extra commission, extra packaging. And they're both per unit figures rather than the lump sum we were given with the advertising. So they're variable costs. And this increases the sales to 17,000 at €34 per unit. So they are going to sell the hoodies for €4 more. They're going to sell more of them, but they are going to have to cover some of the extra costs as well. There are some extra costs. So let's consider the effect that will have. So let's look at part 5 here. Well, the sales is going to be 17,000 by 34, which is 578. Now here's the difficult part of this question. The variable cost is going to be 17,000. Now, you have your original variable cost, which we knew about. Then we have €1 extra for packaging. They're putting the hoodie into a nicer wrapper or a box or whatever it comes in. So, and you have €1.70. Where did we get that? That is 5% of the selling price, which is €1.70 commission. Every time one of your staff sell a hoodie, they're going to get €1.70 sales commission, which is 5% of the selling price. So therefore, the total variable cost per unit is when you add those 3 together, and that's going to be €20.82.5, I think. And that's multiplied by 17,000 units again to get this number here. And then you get your contribution, and your fixed costs never change, and that's going to be a very good increase in profits there, because our profit was 85,000, it's now 118,000, because of course you're selling more of them at a higher sales price. And while we do have some extra costs, not enough to affect the increase in selling price. That is part A of the question done, and the majority of the marks in this question were for part A, and that's kind of a standard marginal costing question with, let's say, a tricky part 5 and a new graph in part 2. You need to be aware of those. Now, in we go to part B of this question. Let's read part B. It says Barry Limited produces 10,000 units of product A, whatever that might be, during the year. 9,000 of these were sold at €4 per unit. So therefore 1,000 of them are not sold, and items which are not sold are called closing stock. 1,000 out of the 10,000 produced, that is 1/10 the closing stock. The production costs were as follows. Direct materials were 60 cents per unit, labor was 50 cents per unit, variable overheads were 40 cents per unit, and fixed costs were 4,000. It says prepare the profit and loss statements under marginal costing and absorption costing principles. There is a difference in how marginal costing, which we're currently doing, and how absorption costing that we've done previously measures these things. We're going to compare them side by side like this. So let's do the absorption costing first, because it's the more straightforward one. You're going to do your sales. Your sales are 9,000 units by 4. That's 36,000. And then you're going to take away all of your production costs. Now, the production costs are by 10,000 because you've made 10,000 items. You've only sold 9,000, but you've made 10. So it's 10,000 by 60 cents is 6,000. And 10,000 by 50 cents for labor is 5,000. And 10,000 by 40 cents for variable overheads is 4,000, and 4,000 of a fixed overhead, which is a fixed cost. You total that up to get 19,000. Now here's the tricky bit. closing, you have to take away closing stock because some of this stuff is going forward to next year as stock. So therefore it needs to be subtracted from the cost of sales. So therefore your closing stock is 1/10 of the cost of production. Closing stock is always valued on the cost price. And how do we know it's 1/10? Because we made 10,000 and we sold 9,000. So therefore the remaining closing stock, the unsold amount, is 1/10 of all of our production. So the value of the closing stock is 1/10 of the cost of production. Cost of production is 19,000, closing stock is 1,900. You take that away to get your cost of sales, and then you take your cost of sales away from the figure above to get your gross profit. And the gross profit is 18,900 for absorption costing. And this is the typical way that a company would do that process. However, when we're learning about marginal costing, we know that some costs are treated slightly differently. We know that fixed costs are treated in a separate fashion and that they're almost not as important, or they're treated secondary. Marginal costing is all about the per unit costs, and that's where it puts its emphasis. So therefore, in marginal costing, we're going to do this slightly differently. We're going to do our marginal costing statement, which is sales, take away variable cost, gives you contribution, take away fixed cost, gives you the profit. But the closing stock is going to be in a slightly different place. Let me illustrate. Sales is the same, 36,000, and that is 9,000 multiplied by 4. Now the variable costs are the per unit costs. 60 cent per unit gives you 6,000. 50 cent per unit gives you 5,000. 40 cent per unit gives you 4,000. You just add up your variable costs to get 15, and it is on this that you take off your 1/10 or closing stock in a different place to the other one because it's a different style of costing. So you take 1/10 away there to get your actual variable cost, which for this year, because 1/10 of it is going forward to next year as closing stock, and that's 13,500. You take that away to get your contribution, and then you take your fixed cost from your contribution to get your profit. You treat fixed cost after the event separately, and closing stock is calculated differently. And therefore, you're going to have two different gross profits. You have a gross profit of 18,900 with absorption, and you have a gross profit of 18,500 with marginal costing. And that's asked in part B to explain the difference between marginal and absorption costing, which I'm going to show you now, and indicate which should be used for financial accounting. Well, the department have written out a very detailed explanation here. I'm just going to highlight some of the important bits. So it says there is a difference in profit figures because closing stock is valued differently. Closing stock under marginal costing is valued lower than under absorption costing. And this is because it does not include fixed costs, whereas it does in absorption costing. Under absorption costing, it's 1/10 of 19,000, which is 1,900. And under marginal, it is 1/10 of 15,000, which is 1,500. And that's a difference of 400. And therefore, the profit is different by 400. And then which should be used for financial accounting? Well, you know, all of this costing stuff is called management accounting, where there is no specific rules. You can use either technique to gain information on your business and on its performance. However, for financial accounting, there are rules. And in that situation, absorption costing should be used. That's the option A above, because it agrees with the accounting practice and concepts, and it also matches costs with revenues. So we should use this one here, absorption costing in financial accounting.